Get ready to buckle up as we're going to take another deep dive into Enbridge. Once boasting impressive fundamentals, this company has faced the unpredictable winds of change. However, has Enbridge adapted and evolved to meet the challenges of today? We're going to deep dive in once again and find out. This is going to be an exciting ride. Enbridge is a Canadian energy infrastructure company that has one of the largest and most diverse energy transportation networks in North America. In fact, they have more than 17,000 miles of pipeline. They transport crude oil, natural gas, and renewable energy sources like wind and solar power through pipelines, storage facilities, and renewable energy products. They also distribute natural gas utilities in both Ontario as well as Quebec. Enbridge is committed to sustainability and aims to reduce their greenhouse gas emissions while prioritizing safety, reliability, and community engagement. They are publicly traded on both the Toronto and New York Stock Exchange with the ticker of ENB on both of those exchanges. They are one of the most significant players in the midstream. Join the conversation. Let us know in the comments if you have any midstream exposure in your portfolio. Your participation is well appreciated. Don't forget to like and subscribe to stay up to date on future content, and thank you for that click. This year has not been as nice to the oil and gas sector as 2021 with that massive boom we had. However, is this current downturn really hurting Enbridge? Do they have enough renewables, and being midstream, is that translating into some profits? Is Enbridge still a must-have stock? We are going to need our friend Mr. Math to figure all of that out. As usual, we will start with some surface data. Enbridge has a market cap of $103.66 billion, and they have a very, very stable beta of 0.89. Their earnings per share come in at 1.28, and they have a price to earnings ratio of 39.99. If we look at their peers, the overall average amongst similar companies is 33.40. So they're a little bit overvalued from looking at that, and their price to book ratio comes in at 20. So that's on the high side. Let's take a look at their revenue and the cash situation. When it comes to revenue, they brought in $53.309 billion with earnings of $2.589 billion. Now, those earnings are projected to grow by 16.86% per year, which is great. Their free cash flow comes in at $6.409 billion, which is also not a bad thing to see. When it comes to return on equity, they come in a little on the low side at 4.64%. Let's talk a little bit about their fair value. Now, they are currently priced at $51.63, and when you look at a discounted cash flow model, we get a fair value of $45.99. That means, yep, they absolutely are overvalued by roughly 12.3%. All right, let's take a look at their returns. We'll start with their dividends. They do have a yield of 6.876%, and that is paid out quarterly in the amount of 88.7 cents per share. Now, that payout ratio that they have on that dividend is really high. It's 268.75%, and we all know that that is absolutely not sustainable. Part of the reason for this is that they are a dividend aristocrat, so they have been raising their dividends for, well, 28 years in a row. So that's one of the reasons that I don't think you're going to see that dividend get cut. This is kind of a moment of pride for Enbridge. So let's actually look at some of their growth. Now, in the 3-year, they rose from $44 to $51.19. That's a return of investment of 16.34%. When we factor in all of the dividends over that time, we got a total return of 38.16%. So that is not bad. Now, let's take a look at 2022. In 2022, they went from a share price of $50.43 to $52.92. That's a return on investment of 4.94%. Add in your dividends, and you've got a total return of 11.76%. Once again, that's really not too bad at all, to be honest. And so far in 2023, they have dropped a little bit from 52.92 to 51.19 for a return on investment of negative 3.27%. They've only had one dividend come out so far, so that means their total return is negative 1.59%. With February being as dank as it was, this is not a surprising result. I do expect them to be back in the positive once we move back into the green. So their growth overall is not bad. I certainly can't complain about it at all. So let's take a look at their debt and see what we got there. So their total debt is $80.984 billion, and their total equity comes in at $63.398 billion. That gives us a debt to equity ratio of 127.70%. That is high. And you guys know I love to have my debt to equity ratios below 100. And one other thing that does concern me, though, is that a year ago, when we did this the last time, their debt to equity ratio was only 119.6. So they have taken on a little more debt over the last year. However, this is a type of company that debt is kind of goes with the territory, especially when you're looking at moving more and more into renewables and expanding. So there can be an overhead. There can definitely be an overhead on this one. Okay, so let's take a look at the short term. In the short term, they have $12.15 billion in assets and $20.30 billion in liabilities. That's not ideal. If we go to their long term does look a little bit better. Their assets come in at $167.46 billion compared to $95.91 billion in liabilities. So there is a little bit of positive there. This is not an ideal debt situation, as they do have some work to do to get it back under control. And as I said, with a lot of their expansion into areas such as renewables, this debt is not actually out of place, which is the one shining light in their overall debt situation. With some companies, this amount of debt would make me very worried, while with a company like Enbridge, this actually does not worry me as much as you might think it would. So, what is the final verdict? Enbridge is huge, and in many ways, their infrastructure makes them too big to fail. Just to be clear, I do not see failure as a remote possibility at all. I do not like their debt, but it is pretty much where I expected it to be, and they will improve on it once the economy turns around. Their dividend is currently unsustainable, but they will keep raising it, as they have a 20-year dividend aristocrat streak on the line. They do have a good cash situation, and they can easily use some of their free cash flow to help maintain that dividend. With earnings forecast to grow, they should be doing overall better sooner than later. Their debt will continue to grow, though, in the current market conditions, though not at an out-of-control rate. Short term, you may not get a lot of returns other than the dividend, which is great. However, long term, this is a company that will provide good passive income, and there will be some growth which will simply enhance that dividend. Still, a good blue chip stock, and also keep in mind, they outperform the market, and in a bear market, that is really all you can truly hope for. Keep the learning going. Watch my video on Tesla linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I'll see you in the next video.